Hi, I'm Monk and this is the Monk Way. In this video, I'm going to show you exactly how I made over $20,000 just by investing in index funds. I'll show every single buy or sell I made in index funds in the past 2 years. I wanted to show you guys that it's possible to make good money safely in the stock market. Watch this whole video because I'll show you the best way to passively invest and make tens of thousands without any real work. Subscribe, hit the bell, and leave a like for more investing videos. I make them every day. And check out my stock market group below to see every single trade I make, like Aurora Cannabis, up 50% since I bought in. I also have links to the best free investing apps to buy these funds with. Webull for the active part of your portfolio, get 2 free stocks just for signing up. M1 Finance for the passive part of your portfolio, buy partial shares of stocks like Amazon for pennies. Look in the description for these links. I believe index funds are the best way to invest in the stock market. Personally, half my money are invested in these funds. They're the most passive way to watch your money grow. This means that you can buy these funds one time, leave it in your brokerage for the next 10 years, and come out with a lot of profits. Before I show you my profits, why don't you see what kind of returns the S&P 500 index fund can return? Over the past 100 years, this fund returned an average of 10% a year. This means that if you buy this fund one time, it might increase your money by 10% every year, but only if you keep it for the long term, 10 years plus. Just 10% a year can turn $400 a month into $1 million in 40 years. So just saving that extra $400 a month and buying this fund will make you a millionaire by retirement. This is the power of compound interest. It only takes 30 years to become a millionaire if you invest just $800 a month. I've really hammered this point in my previous videos, so let's take a look at the real world example of what this fund can do. We'll go to my real brokerage. This is actually just my bank, which charges me $7 a trade. Not the best way to invest in index funds, but it's convenient. The best way to buy these funds is for free. If you're American, check out Webull or M1 Finance below. They allow free buys of these funds, saving you hundreds a year. This is exactly how much index funds I'm holding right now. About $120,000 worth. $50,000 in the S&P 500 and $70,000 in the Nasdaq 100. They're pretty similar funds. As you can see, these are the Canadian versions. The symbol VFV is the Vanguard S&P 500 for Canadians, and XQQ is the Nasdaq 100 for Canadians. They move at the exact same pace as the American funds. You can buy these same funds in America with the symbol VOO. That's the Vanguard S&P 500. Probably the best version of this fund. They only charge 0.04% a year in fees, and QQQ for the Nasdaq 100 with a 0.2% fee. This fund is more technology focused, so it might grow faster. Right now the S&P 500 is up 6.8%, or $3,360, and the Nasdaq is up 4.7%, or $3,440, for a total return of $6,800. This is not bad, but it could be a lot better. Let's see when I bought these funds. It looks like it was bought in June of 2018, which is about 9 months back. Looking at this charts, we bought it right here. This fund actually dipped hard right after, going down as much as 13% in December, but bouncing back to the green after a few more months. This is why you have to hold and buy more when this index falls. If you sold it in the red, you will never make money. Index funds are very safe, but only if you can keep them for 10 years or longer. Investing is safe, trading is not. Let's see what happened if you bought here in a better time, back in 2017. If you spent all of our money, $120,000, and bought here in the beginning of 2017, it was $208 back then. And today, we would have over 30%. This is a profit of $36,000, just for holding this fund for 2 years. Think about this. 2017 was not that far back. I remember buying this fund around there. I sold it and rebought it a few times, causing less profits. So if I just bought in and held it for 2 years, I could be up $36,000 right now. This fund really blew up in the past 10 years. Let's say you bought right here in 2012. In just 7 years, you could have made over 160%. This is a return of $192,000 on your $120,000. This is why I recommend an index fund for everyone. But I'm not done with the profits just yet. I said we made over $20,000 with this fund, so I'll show you the other times I bought in. Since the S&P 500 is a combination of the biggest American companies, it really moves up and down with the American market as a whole. This means that 20% dip we saw in December of 2018 probably caused even bigger dips on single stocks. I remember some blue chip companies that were down as much as 40%. So when it comes to trading, the best way to invest in an index fund is to buy more when it drops. If I bought the S&P 500 when it dropped 20% just a few months ago, I would have made a nice 20% in less than 2 months. Even adding just $20,000 to my $120,000 would mean an extra return of $4,000. I didn't do this at the time, but I would likely do it in the future. These 2 years of trading instead of investing taught me the perfect method to actually invest and make good money over the long term. Let's move on to my previous purchase of an index fund. We saw that I bought $120,000 in June of 2018. When did I buy in and sell before that? Checking my online brokerage, we can see that I bought some more on February 16th for $61,000 and sold it on March 21st for $64,000. A quick month's trade for $3,000 profits. This was in my tax-free accounts, but I bought more in my cash account. $84,000 in my cash account on February 16th, and I sold it for $88,500. That's a profit of $4,500. In total, that was a quick 5% return because I bought a dip. So far we have a $6,800 profit, still holding. $9,500 profits back in March 2018 for a total of $14,300. There was still another purchase for a profit of $6,400. Let's go back in time and see when I first bought index funds in this bank. Back when I didn't know that I held a mutual fund, which charged me 0.5% a year, which is not too bad, but compared to the 0.06% I'm paying now, that's 9 times the price. The first time I bought a mutual fund was back in April 2017. On one account, we bought $50,000 worth, sold for $53,000 or $3,000 profits in February 7, 2018. In the tax-free accounts, I bought $52,000 worth and sold it for $55,400, giving us a profit of $3,400 for a total profit of $6,400 or 6.3% profit. That's not bad, but it could have been 14% or $14,000 if I sold it right here before the crash or just kept it for later. But at least I did buy back a few days later for a quick 5%. It goes to show that timing the markets will lose you money. I did not time it correctly. From April 2017 to March 2019, this fund went up 25%, a huge bull run, meaning I could have made $25,500 from my initial deposit of $102,000. But instead, I made $20,700, missing around $5,000 total. To show you the simple timeline, I first bought in here on April 2017, sold it right after the drop right here on February 2018, bought back a few days later for a quick 5%, but it dipped again, causing me to wait until June to buy back in. Overall, I missed about 6% in returns by trying to time the market. The advantage would be, if the market did continue to drop, holding money in that situation could make you rich. But since it didn't drop, I probably missed around $7,000 total profits. Let's see what the best strategy would be here. If we started with just $100,000, let's say we started at the same time in April 2017, and it kept going up for a few months, up 15% by the end of the year. That's a $15,000 return on $100,000. Then it was up 23% at the highest point. But instead of trying to time the markets, we don't sell it here when it's going down. Instead, we buy more. It dropped 9% right here. Let's say we bought another $10,000 at the 9% drop. That $10,000 would be up 10% in today's worth, or $1,000 profits. And let's say we bought $20,000 on this huge drop. Even if we didn't buy at the lowest point, we would be up 15%. That would be a $3,000 extra. A combined profit of an extra $4,000, or 13% on the extra money we put in. Not only that, we have our initial 25% increase, because we didn't touch that first $100,000. So in 2 years, we made $25,000 and an extra $4,000, for a total of $29,000. This means if I played it perfectly, I could have made $10,000 more. Of course, that was the perfect situation. Does this work in an actual market crash? Let's go back to 2008. If we bought at the highest price right here, we would be in the red for a long time. More than 5 years in the red. Let's use our $100,000 example again. We bought in at $155. It starts dropping month after month, until it reaches here at negative 50%. What if we bought more during that time? Let's say we saved a lot from an actual job and put more money in. We saved the extra $50,000 over 2 years, and bought in more when it was dropping. There's no way to buy in perfectly, so let's say our average was around $100. In 5 years, from August 2009 to August 2014, we had a return of 100% on that $50,000, meaning a profit of $50,000 plus dividends. What about our initial $100,000? From July 2007 to July 2013, it only increased 10%, or $10,000. That's a 10% return in 6 years. Not the best. But since we have $50,000 return from buying more, that's $60,000 in total, or 40% from our $150,000 invested. So instead of getting only 10% in 6 years, we made 40%. This keeps going up from here. The average investor might have bought in here at all-time highs, and sold everything for a loss when it dipped 50%. Or if they're smarter, they kept it for 6 years until it's break even. But the smartest investor bought more during the dip. Instead of timing the markets, he just keeps buying as it drops. If it dropped 10%, he bought some. If it keeps dropping 20%, he bought some more. At 50%, he put all his money in this fund. And now he got away with 40% in returns in a market crash. The power of dollar cost averaging, and saving a lot more during a recession. So the best strategy is to buy in slowly, and buy in a lot more the harder it drops. If I had $300,000 in cash right now, I would buy this index slowly, maybe $15,000 at a time, every single month for the next year. After 10 months, we'll have $150,000 in this fund. If it happens to drop, then I'll invest $150,000 more if it's a heavy drop, or slowly invest the rest as it drops slowly. If it doesn't drop, I will keep the other half until it starts dropping. This is because the market crash could definitely happen soon. It's been 10 years since the last market crash, and the average crash happens every 9 to 10 years. This is the safest and simplest strategy for the average investor. No time in the markets, slowly and safely investing in the markets. The more cash you have when a crash happens, the more profits you'll make. It's possible to get a 300% return on half your money. That's $450,000 on $150,000, while the other $150,000 can ensure you're still making some money while you're waiting for a crash. If you're interested in the best investing app for these funds, try Webull or M1 Finance below. Both apps are 100% free to use. No charge for trades or to own an account. This means you could buy VOO or the S&P 500 and pay nothing except for the fund fee of 0.04%. Webull is great for swing trading. They have full after hours trading, 4 AM to 8 PM. That's 8 extra hours of trading. They also give you 2 free stocks worth up to $1,000 for signing up. M1 Finance is great for fractional shares, so you can buy Amazon and Google for pennies instead of $1,000. Click the links in the description for the best investment platforms. Subscribe, hit that bell, and leave a like for more investing videos. I make them every day. Keep watching to buy the best index funds the Monk way.